FM presented the fourth union budget of the present government. The focus was to discourage profit shifting and base erosion, which is the global concern shared by both developing and developed countries. For this, the government announced the amendment of Section 94B of Income Tax Act so as to disallow the deduction on interest paid by Indian company or PE of foreign company in excess of 30% of EBITDA or interest paid to its A while computing taxable profit. Further, to snatch excessive money available with the A's, the tax department has introduced Section 92CE so as to provide with secondary adjustment for income attributable to profits earned by PE of a non-resident company which are not repatriated to India within the prescribed time limit. Coming to fair market value of assets, for computing accreted income on which TDS has been paid, it shall be taken as cost of acquisition of that asset. Further, income deemed to arise outside India through investment in foreign company in the garb of transferring underlying assets located in India will not include assets held by non-resident by making investment in registered FIs, FPIs for purpose of taxation. This retrospective amendment will be effective from April 1st, 2012. Maintenance of minimum fund size by a foreign portfolio investor under Section 9A will not apply to offshore funds which has been wound up in previous year. Additional time is to be given to AO or assessing officer for allowance of disputed foreign tax credit after completion of settlement. Further, costs incurred by the resulting foreign company for acquiring shares of Indian company in a tax-neutral demerger will be same as it was in the hands of a demerged foreign company. Terms which are not defined under the double taxation avoidance agreements will have the meaning assigned to them under the Income Tax Act. For this, amendment has been proposed in Section 90 and 90A. Payments made to relatives, related persons specified under Section 48(2)(b will not be a part of specified domestic transactions under Section 92BA. Now, relief granted to non-resident investor in respect of gains arising from appreciation of rupee against foreign currency during redemption of masala bonds or rupee denominated bond is to be extended to secondary holders as well. Transfer of rupee denominated or masala bonds issued by a non-resident to another non-resident cannot be construed as transfer of assets under Section 47 of Income Tax Act. Non-residents having no PE in India are to be excluded from purview of newly inserted Section 206CC, which provides for pan coating mechanism in the TCS regime. To give fillip to the ECB market, concessional withholding rate of 5% on interest received by foreign entities to be extended for another 3 years. This extension is also applicable to masala bonds. Now let's focus on the indirect tax side. With the GST round the corner, this budget did not see any major changes on this front. Now let's quickly look at the important highlights. Anomaly in construction services removed as Service Tax Determination of Value Rules 2006 is proposed to be amended retrospectively. Rule 6 of CCR 2004 rationalized for banks and financial institutions including NBFCs. Export-oriented units or EOUs can now procure inputs, raw materials at concessional duty as bar under Section 5A is only for goods manufactured by EOUs. Time limits extended for grant of remission of duty, transfer of SENVAT credit. Interestingly, the government has merged the authority for advance ruling for customs, excise with authority for income tax. Service tax exemption benefits to Indian Institute of Management, that is IIM's, word residential has been deleted. Settlement Commission for Custom Excise have now been empowered to rectify error apparent in its orders.
One thing which is missing, I thought, is that, during the budget speech, Finance Minister has spoken quite with a lot of pride about the GST being implemented soon and all. So I waited that after that he will give some direction to show that there is a convergence of the existing excise and service taxes towards GST. And because you have to keep in mind that there are still 5 months left. So this was an opportunity to give, but then I found nothing of that sort. Well, I tell you how. There are still a few technical issues which are yet to be resolved. So one is that there are a number of exemptions. In excise side, before this budget, I have not counted after this budget. Before this budget, there was more than 350 exemptions on excise side. And state VAT exemptions are about 98. But obviously, in GST regime, it will be a common list of exemptions, and it will be much less than 350 and a bit higher than 98. So and the officers are working on it. So I thought that some exemptions should have been pruned, and so that the taxpayers don't get a shock suddenly. All the exemptions have gone, quite a few in certain sectors. So that was not there. I expected some exemption to be coming. That was not there. Secondly, the rates of taxes have been decided that it will be 5% for poor man's items, 12% for Aam Aadmi, common man items, standard rate 18%, and then 28% for the demerit goods and edited waters, tobacco, cigarette, luxury car, etc. So I'm not saying that he would keep these rates slabs, because after all the tax base is different, so you can't have the same rate. But he could have made into 4 slabs, whatever rate it comes, and once he makes it into 4 slabs, then put the items there, because they have yet, up till now, they have not yet put the items which will be in 5% or which will be in 12%, that slabs. So this was an opportunity to try certain things with it, because after all, ultimately he has to do it in consultation with the states. But he could have tested the water by putting that these are the items and this. So this was also not done.
Now let's focus on the other critical issues of the budget. Target for agricultural credit has been fixed at Rs 10 lakh crores. As far as railway sector is concerned, total capital and development expenditure of railways has been pegged at Rs 1,31,000 crores. Further, new metro railway policy is to be announced by the Government of India.
How would you rate the budget for your sector specifically in terms of tax reliefs?
Specifically for railways, it got the right representation as a part of the complete transport and multimodal let's say measures of transportation, and you saw that the transport sector got nearly 240,000 crores, which is and the railway sector 131,000 crores, which is higher than last year's budget. Glimpse that there would be a new metro policy, and Tier 2 cities, airports act could be changed to monetize the land. So all points towards progressive.
Coming to the financial sector, the FM announced that 90% of FDI coming to India is through the automatic route, and therefore the Foreign Investment Promotion Board, or FIBB, is to be abolished in the year 2017-18.
So abolishing the FIBB is a very sensible and good move, as 90% of all investments now come in on the automatic route. Very welcome. And then two announcements that were made for the financial sector. First, that dispute resolution of existing PPP projects would be addressed through amending the Arbitration and Conciliation Act of 1996. And second, that there would be a time-bound mechanism for listing of central public sector enterprises. Both those are good to hear.
As a measure of digital push, the government is going to launch 2 new schemes to promote the usage of BHIM app, a referral bonus scheme for individuals, and a cashback scheme for merchants. Also, there is a proposal to create a payments regulatory board under the aegis of RBI. Most importantly, the government has accepted the recommendation of the SIT on black money, and therefore no transaction above Rs 3 lakh would be permitted in cash, only subject to certain exceptions. Finally, in the sector of higher education, a single body called as National Testing Agency for Higher Education Institutions to be set up. With this, we conclude these highlights of Budget 2017. Stay tuned to TIOL2 for detailed analysis, which is coming soon. Thank you for watching.